What's going on, everyone? Charlie here. We're going to be going over capital requirements in a little bit more detail. We're going to go through an overview, and we're going to be using the document Bank Capital Requirements, a Primer and Why, which was issued on March 9th, 2023 by Congressional Research Service, Andrew P. Scott. Capital requirements are statutorily mandated, but statutes provide regulators with discretion to set them as deemed to be necessary and appropriate. Capital rules are set through regulation by federal bank regulators. So that would be the Federal Reserve, CFR, Code of Federal Regulations, the SEC. And capital requirements are a key prudential measure that banks must meet in order to operate in a safe and sound manner. Financial regulators at the state and federal levels take a number of measures designed to ensure the financial health of banks. So they're working around the clock to ensure the health of banks. Because remember, too big to fail, there's a lot that goes into that. Now, capital standards serve to provide a buffer between losses and systemic risk. So that's the whole point of these capital requirement standards. Now, a bank's capital is the stock or equity that represents the owner's stake in the bank. By setting capital requirements, regulators compel banks to acquire at least a certain amount of funding from this source. Capital is the buffer for the bank that protects the financial safety from losses, or financial safety net from losses. So they want banks to have a certain amount of capital set aside so that they can absorb losses in a scenario in the market or any other financial stress situation to minimize the impact of that situation. Now, the term bank is used generally in this report to refer to an institution subject to capital requirements and has a primary regulator as its primary regulator. There are more exotic types of bank charters that 3 regulators have respective jurisdiction over that are ignored here for simplicity. Regulators establish a number of capital requirements that determine how much capital an institution must hold to remain adequately capitalized. You hear Jerome Powell talk about it all the time. He always makes the claim that the biggest banks are adequately capitalized. The reason they know this is based off different tests that they conduct. Capital ratios are calculated as a percentage of total risk-weighted assets, or RWA. Risk weights are not the amount of capital required, but the percentage counts towards the denominator of the capital ratio. The advanced approach is required for only the 9 largest, most complex institutions, although other banks may voluntarily adopt it. So it's required only for the 9 largest, most complex institutions. Now, a 1983 Federal Appeals Court ruling called into question the authority of bank regulators to enforce capital rules on banks. The FDIC, or the Federal Deposit Insurance Corporation Improvement Act of 1991, built on this rationale to establish criteria for which regulators would take certain remedial actions based on the capital positions of each institution. A bank that is less adequately capitalized in order to restore its capital levels is not subject to supervisory action. So this is where you get into a sticky situation with player size. Because again, a bank that is less than adequately capitalized in order to restore its capital is not subject to supervisory action. Regulators evaluate for capital adequacy as part of their supervisory exams. Banks are required to hold at least 4.5% common equity, 6% of Tier 1 capital, and 8% of total adequately capitalized. Now, Basel III raised the minimum leverage ratio from 3% to 4% for certain banks, including those with a strong supervisory rating. As the CCB falls below 2.5%, regulators impose increasing restrictions on capital distributions. The leverage ratio is the ratio of Tier 1 capital with certain adjustments to consolidated assets. In 2019, the federal banking agencies issued a final rule that simplified the measure of capital adequacy for qualifying community banking organizations. Hold on, let me turn that Discord noise off so that doesn't become a problem. Sorry about that. Back to it. In 2019, the federal banking agencies issued a final rule that simplified the measure of capital adequacy for qualifying community banking organizations. Qualifying institutions were given a 2-quarter grace period in 2022 to bring their leverage ratios in line with the 9% requirement. The failure of large financial firms can trigger financial instability, which in some cases prompted extraordinary federal assistance to prevent their failure, which we all saw not only in 28, but recently here as well in the COVID era. Now, many of these capital requirements originate from Basel III rather than the Dodd-Frank Act. Large, complex banks have been required to use advanced approaches to model risk for more sophisticated financial activities. Small banks, on average, have fewer off-balance sheet exposures, obviously. Now, large banks' capital requirements are partly determined by stress tests, which we hear about all the time from Jerome, capital planning, which we hear about out of these filings that come out, and the stress capital buffer. Title I of the Dodd-Frank Act required, number one, company-run stress tests for any bank or non-bank financial firm with more than $10 billion in assets. Number two, Fed-run or supervisory stress tests were implemented beginning in 2012. Stress test attempt to the losses that banks would suffer under a hypothetical economic and financial downturn. Now, the final rule for capital planning was implemented in 2011. Each bank must submit a capital plan to the Fed annually. This plan must demonstrate that the bank will remain in compliance with capital requirements under the stress tests. And the yearly results to these stress tests are available at this link here. I will link it in the description below. You can actually go and see their yearly stress test results. Banks subject to stress tests every other year use those results to determine their capital requirements for 2 years. Now, the Fed has provided 3 justifications for making these requirements less stringent. The Fed argues for removing stock repurchases from capital planning on the grounds that only dividends are likely to be continued as planning in a period of financial stress. So, what have you seen the last couple of years? You've seen stock buybacks out the wazoo. That's another way for them to garner capital, especially when the market's going up. Now, the Fed issued a 2017 final rule implementing a total loss absorbing capacity, or TLAC, requirement for United States globally systematic important banks, or GSIBs. And the TLAC requirements do not require banks to hold more capital, but can be met through additional capital or eligible long-term debt. In practice, TLAC has always been set at 0 since inception. The basic capital requirements discussed in this report are summarized in Figure 2 for risk-weighted and leverage capital requirements and Figure 3 for leverage requirements. We'll look at that in a second. Banks underneath the $700 billion in assets ratio are ranked as Category 2 if they have over $75.5 billion in cross-jurisdictional activity. Banks can use Common Equity Tier 1 or Set 1 capital to meet other Tier 1 requirements. Now, capital requirements could be designed to achieve the goals of safety and soundness and financial stability with the least distortion in the specific economic activities. Capital requirements should be set high enough that, along with other prudential requirements, bank failures would not cause systemic risk, which imposes economic costs, or require taxpayer support. But raising capital requirements could boost credit availability as moderate capital levels would increase. Now, current capital requirements are too high, too low, or about right would need to be modeled based on theory and underlying assumptions about the societal costs and benefits associated with capital requirements. Capital requirements have become more complex and more sophisticated as the business of banking has also become more sophisticated. So the markets are evolving. This whole situation, this whole space is evolving. We've all seen it, and it's just getting started. Now, capital regulation is no longer based on the principle of matching risk with capital, and it has the potential to create perverse incentives for banks. The size of the bank binds the bank's capital decisions rather than the riskiness of its assets. So this is the big problem. The size of the bank binds the bank, not the riskiness of its assets. Now, in practice, this is more likely to occur for the largest institutions because they're subject to none other than the supplemental leverage ratio, which was modified back in 2020, which allowed for a large run in the markets and basically led all the way up to the January events of GME and AMC. And then right before that SLR relief expired, you saw all that craziness happen in January, February, and early March. And SLR expired March 30th of 2021. Now, since the CCYB was implemented, which is basically it's called the counter-cyclical capital buffer, and it aims to ensure that banking sector capital requirements take account of the micro and macro financial environment in which banks operate. Its primary objective is to use a buffer of capital to achieve the broader macroprudential goal of protecting the banking sector from periods of excess aggregate credit growth that have often been associated with the buildup of system-wide risk. Due to its countercyclical nature, the countercyclical capital buffer regime may also help lean against the buildup phase of the credit cycle in the first place. In downturns, the regime should help to reduce the risk that the supply of credit will be constrained by regulatory capital requirements that could undermine the performance of the real economy and result in additional credit losses in the banking system. So, what have you heard so far? It's all about protecting the banks, protecting the banks, protecting the banks. And since the CCYB was implemented in 2013 in the United States, it has been continuously set at zero. It's never had to been used to reduce or absorb losses in a stressful scenario, which just goes to show it's not as bad as they make it and they like to make it to seem. Well, that slide is the same thing, but it looks a little jacked up. We're going to skip that. Now, TLAC is currently only applied to, again, globally systematic important banks because they are the most likely to be too big to fail. The most common form of resolution is for the FDIC to sell a failing bank's operations and assets to a healthy bank. And this is why you see all these mergers, consolidations, because they don't ever fail. They just get all of their stuff lateraled to the next healthiest bank that can absorb everything. Some regulators have suggested that a permanent change would be desirable to address the underlying issue. The supplemental leverage ratio should be recalibrated to reflect a financial system with more treasuries and bank reserves. The increase in safe assets during the pandemic was the byproduct of the increase in bank deposits. That's where it gets interesting. And we're going to touch on that in a second. But the Fed and the OCC proposed a rule to modify the ESLR for GSIBs recently. And the modification is as follows. Instead of 5 and 6% for the holding company and depository subsidiary, the proposed rule proposes setting the SLR at 3% plus half of the GSIB surcharge. The proposed rule would reduce capital requirements, again, reduce capital requirements under the ESIB to between 3.5% and 4.75%, down from 5 to 6%, depending on the size of the bank. So again, the capital requirements that apply to these larger banks that's in the works now, is going to be in full scale in 2028, not the same thing for the small and medium-sized players, which are furious because this is a clear lean towards helping the bigger players and pushing out the small and medium players. Now, expected credit loss, or CECL, requires banking organizations to recognize lifetime expected credit losses and to incorporate reasonable and supportable forecasts in developing the estimate of lifetime expected credit losses. Traditional commercial banks are relatively limited in their exposure to cryptocurrency, and traditional banks are currently not allowed to accept crypto deposits. So keep that in mind. That is probably very relevant for anybody that's interested in the crypto market right now. Now, in 2022, the BCBS has issued its second consultative document on the regulatory treatment of crypto exposures. The new framework refines the way crypto is classified and includes a stabilization test for certain stablecoins, and also introduces a new requirement to account for risk to digital infrastructure. So crypto's in the works too. A lot of moving parts right now. Now, there has already been some divergence with U.S. implementation of Basel III and the Basel III agreements. For large banks, implementation of the endgame could result in higher or lower capital requirements. And knowing how these banks work and operate, it's more than likely going to be that they end up getting lower capital requirements because between now and then, they'll pull a magic hat out of their ass and figure out a way to be systemically sound. Now, National Banking Act of 1864 actually sets an early example of formation of capital requirements. At formation, banks were required to establish minimum capital levels, such as $50,000 for banks in cities with fewer than 6,000 people. Capital was defined in terms of capital held against assets that were associated with greater risk than treasuries and other risk-free assets. The average capital to deposits ratio from 1920 to 1939 was 15.2%. Now, the Basel Committee was created in the wake of the international financial market turmoil caused by the 1970 exchange rate crisis. Since 1988, the year after the flash crash, the BCBS has issued 3 iterative frameworks, and you've probably heard of them. They are referred to as Basel 1, 2, 3, and we have the Basel Accords. Basel I was established in 1988 and focused mainly on credit risk, establishing a classification system for risk-weighted banking assets. In the 1990s, it became apparent that some limitations were needed for larger banks after the big Salomon Brothers scandal. In response, the United States regulators initiated a revision to the capital framework, which became Basel II. The final rule, issued in 2007, was implemented in 2007, just before the whole crisis occurred. Now, the Basel Accords do not require congressional approval, but Congress can nevertheless make statutory changes to capital requirements, regardless of whether they are part of Basel III. Banks required to use advanced approaches would be redefined in none other than 2019. Now, this is where we get back to the treasuries versus the non-treasuries as far as capital requirements. Well, if you look at the repo market, what do you notice that's been going on since 21? Since SLR expired back in 21. It's been going to historic levels that have never been seen before. The only other time we've seen levels anywhere near remotely close to where we're at now, which is never, but from a starting point, is 2014. Well, it just goes to show that 2014, the United States began implementing the first round of Basel III standards in 2014 after a couple of years of proposed rulemaking. The implementation of each of these provisions was phased in over several years, with most parts phased in by 2016, right here, but some subparts being implemented in 2022. So they had to take a break in 2018. Then we had the whole COVID stuff happen. SLR happened in 2020, and then the repo goes to all-time highs in 2021. Congress passed the Economic Growth Regulatory Relief and Consumer Protection Act, or EGRR-CPA, in 2018. So all this shit ties together. Now, this report should not be relied upon for purposes other than public understanding of information provided by CRS to members of Congress. CRS reports are not subject to copyright protection in the United States. In essence, in conclusion, the presentation covers key aspects of bank capital requirements, including statutory mandates, regulations, prudential measures, and the role of federal bank regulators. It emphasizes the importance of capital rules and ensuring safe and sound banking operations. Hope you enjoyed this one. I'm back, motherfucker.